Let's take a look at some law of vibration basics. Let's take a look at it from a price perspective. What I'm showing here is a note frequency chart. You can see the notes on the left, top to bottom, C, C sharp, D, D sharp, all the way down to B. And then the octave from low to high going across, covering a range of 10 octaves. For the C note, the lower octave at 16.35, doubling the tone to create each succeeding octave. Octave 4 to 61.63 is middle C, basically on a piano. So what we're going to do is take these tone frequencies and mark them with horizontal lines on a chart. And I'm going to start on the S&P. I'm going to mark the range back to around 2015 or 2016. I'm going to start at 1975 and mark these intervals all the way up to 55.87 as the market is currently trading in the 5100 area. So now we're going to take a look at the chart just from the musical frequency perspective and look how the market responds at these levels. So we're only looking at a part of the price component here. I've talked about wavelength and frequency in other videos, which are important parts of the law of vibration. I also did a video where I took a look at Tony Plummer's pattern along with George Bayer's Egg of Columbus book and Martin Armstrong's cycle. So you might want to look for that video. You can search Bayer, Armstrong, Plummer in the title. All three words are in the title. You'll easily find that. And that talks a little bit more about the time component and how to set that up. But in this video, we're purely going to look at the price only. When looking at any market, what you want to do is take a look at these frequency levels and plot them on your chart. So what I've done here is mark those accordingly off the frequency chart that I just showed. And you can see I was down at the 1970 level, went all the way up to the high 5500s here. Right now we're trading between these two intervals here. So what I've done in the most recent action, I've marked the note or the tones here. So I have the crimson line here is a D sharp, which would also be an E flat. And then the octave below is this red line or crimson line here, which is a D sharp. Now just below the D sharp is a red line, which is the D tone. And the octave down from the D tone is the red line down here in the high 2300 area. Now I've got the B levels marked in brown just to give us a little bit of a way to identify these as we look back. And I've also marked the G tone in green. So when we look back at the prior areas, we can see these is an easy reference line to compare these tones. So just working backwards here, you can see we've got a major low at the C interval here. We've got a major high and a consolidation at D. These C sharp is more of an intermediate tone. You can see that we've got this resistance, support, resistance here on a little intermediate wave, resistance here, support here and here and here going back. The more major level was the A sharp level for a low. The B level's pretty good low, but it still could be considered to be an intermediate low as part of this big move down in the 21 to 22 bear market. And then this major high was in the D sharp area. So those are kind of the key points on this chart at those particular intervals. Let's move back a little bit in time and take a look at the preceding part of the chart. Here's the 20 area. You can see we had significant low at D sharp here, significant low at D. Here is our G line, the green line. We had a significant top there, fairly significant. In the middle of the move, caused a three-wave reaction. Became resistance twice more before it traded up to the next two levels up, which were the A and A sharp levels where we had significant highs. So the D sharp, A sharp areas are important. Let's take this back to the couple years prior to the 2015 to 2017 area. Here's that particular chart. You can see we had basically a quadruple bottom on the B tone level with the brown line. Remember, the brown lines were the B tone. And that quadruple bottom formed during 2015 and the earlier part of 2016, where we had the double bottom in January and February here. Now, what you want to do, you can take a look at these areas between these tone frequencies are intervals. So let's just call these the intervals between these significant highs and lows. So what we can do is count the intervals and count the intervals in the reaction, and we can get comparison and an idea where the market may be going to. So once we came off this quadruple bottom, the market moved up and went to a significant high before we had an intermediate down move. It went up to the green G note. So from B up to that G note, we have gone up 8 intervals. Let me bring in the second chart again. So we went up 8 intervals to this high here at G back in 2018. So that took a better part of 2 years. And then what happened after that, we moved down 4 intervals to the D sharp level. So we basically, in terms of intervals, had a Gann correction of 50%. Not in exact terms of price retracement, but in exact terms of interval, where we had 8 intervals up and 4 intervals back down again. The next bull move up from the 18 low, the market went up from D sharp 6 intervals, and then we got to the COVID crash in 2020, and the market rolled right over and very quickly, within a matter of a couple months, made a 7 interval down move to the D tone, where the market made low in March and then started trading back up again. In the next significant move up, the market went up 8 intervals. It went up past the prior high 1 tone interval, and it corrected and could not even get back down 2 tone intervals. So we couldn't even make a 25% interval correction there. That is to be considered a sign of strength, because when the market cannot come back and go 2, 3, 4 levels, it's going to continue to advance. And since we fell short of correcting even the 2 intervals, the market was geared to move much higher, and it did that after it broke out of the double top here at that interval. That particular interval was the A sharp tone. Let's move back to the current time period. The market continued moving up into late 21, early 22, where the high was made at D sharp. We had a 5-tone move to B. We went better than 2 back, but couldn't get to 3, and ended up completing that bearish move down at the A sharp level, which was the area of the prior highs of that double top. A complete move down is 5 intervals. Now what happened in the ensuing move up, we went up 3 intervals before a more significant correction. So we corrected back 2 intervals, or a 3 to 2, which is a 1.5 or a half octave or a 50%, or a 2 to 3, 0.66, which would be your Fa level. So another important ratio set, however you want to look at it, 3 to 2 or 2 to 3. The overall move up from the A sharp low was 4 intervals up to the D note, and then it made a 2 interval correction down to the C tone for another 50% reaction based in terms of intervals, not specifically price. When looking at these tones, consider that D sharp is E flat, C sharp could be D flat, A sharp could be B flat, and so on. So you can identify a scale. Right now we're looking at the full 12 notes of the chromatic. You can identify a particular scale and find the most important tone frequencies in any stock or commodity. So you have to look at each one, and you have to look at this in terms of wavelength. You have to measure your wavelengths up and your wavelengths down and work in terms of these wavelengths, because the market's going to make maximum movements in both directions, whether you're in a bull or a bear market. There's another thing you can do here. I'm going to give a little bit of a clue. Let's say you want to create a time cycle off of significant high or low. Let's just say we want to take the low of this A sharp level. So let me bring in the frequency chart. So that A sharp tone, there's the A sharp on the left. That A sharp tone was of that low was at 3729.31. What you can do then, you can take all these frequencies in this row of the A sharp tones and start measuring from that low, and you'll get pivot points in the market. So from that low at the A sharp tone, you can measure over 29, 58, 116.5, 233, 466, and so on. And you can even take the halfway points between these tones, which would basically give you the so tone in between on these octaves. And those are the most harmonic points. So you can get your time cycles out of here as well. And you can do that not just off of one, but you can take any high or low that was made at one of these tone levels and run those time counts forward, and you're going to start to find a confluence pattern, and you're going to get places where if you run these off a half a dozen pivots, you're going to get points of confluence where you'll get 2, 3, 4 hits come together and give you some of the more significant swing points in the market to set trades up off of. So when you get time coming together with price at these tone frequencies, you're going to get really good trades. So again, this is kind of a little bit of a primer for the price component of the law of vibration, but this is just a little bit more insight into the law of vibration. So if you watch the other videos that I mentioned early on here, you'll get more of an idea of how to fit the time and pattern components into this.